Welcome to Talk Tickers.
Great to be here.
We are back. And today we're going to do something a little different.
Yeah.
Usually, we're looking at tech giants or all the flashy stuff moving the NASDAQ. But today I want to talk about the invisible architecture of the financial world.
Okay.
I wanted to talk about the sector that I think most people fundamentally misunderstand.
I think that's fair to say.
When the average person walks past one of those massive insurance buildings in like Hartford or Des Moines or Omaha, what do they see?
They see a utility, a boring utility.
Right, exactly. They see a boring, necessary evil. They see monthly premiums. They see claim forms.
They see a lizard on a television commercial making jokes about bundling.
Yes, that's what they see. A business that exists to, patch up a fender bender or pay out a life policy when things go horribly wrong.
Yeah.
It's sleepy. It's safe. It's boring.
And that is absolutely the consumer view. It's the view from the sidewalk, as you put it.
But it's not the whole story.
Not even close, because if you go up to the penthouse suites, if you talk to the smart money, and I'm talking about the institutional allocators, the private equity titans, the hedge fund managers, they don't see a utility company at all.
What do they see?
They see something entirely different. They see a weapon.
A weapon. That's a strong word.
A financial weapon. They see a massive leverage financed investment fund that is just brilliantly disguised as a boring old operating company.
Which is exactly why we're doing this today. This is the deep dive. We are unpacking the engine room of the insurance industry.
I like that, the engine room.
We aren't talking about premiums and deductibles today. We are talking about the float. We are going to analyze how over $8 trillion of industry assets are actually deployed.
An unbelievable number.
And we're going to look at why that strategy is shifting right now. Moving from boring public bonds into things like private credit, and why this concept of permanent capital has become the absolute holy grail for alternative asset managers.
This is such an essential conversation because really, understanding an insurer's investment portfolio is arguably just as critical.
If not more so.
Right, if not more so than understanding their underwriting discipline. You just cannot value these companies if you don't understand how they handle other people's money.
It's like trying to analyze a bank by only looking at the teller windows and completely ignoring the lending desk.
Exactly. You're missing the entire business model.
Okay, so let's start at the very, very beginning. The core concept here. The float. Now, definitions can be boring, but this one.
Yeah.
This one is the foundation of the entire empire.
It is.
So what is the actual, textbook definition of float in this context?
At its simplest level, float is the money that an insurance company holds between the moment they receive your premium and the moment they have to pay out a claim.
Okay, so there's a time lag.
A huge time lag. Think about the timeline. You pay your car insurance premium on the first of the month.
Right. It comes right out of my bank account. And I might not have an accident for 5 years.
1 year.
Or hopefully never.
Hopefully never, exactly. But that money isn't just sitting in a vault gathering dust. It's not in a Scrooge McDuck money bin somewhere.
No.
The insurance company holds it. And while they hold it, they invest it. But here is the critical reframing that I think investors need to make.
Okay.
Float is essentially a loan. It's a loan from you, the policyholder, to the insurer.
Okay, hold on. A loan implies I agreed to lend them money. When I pay my Geico bill, I don't feel like I'm becoming a lender. I feel like I'm just paying a bill.
I get that. You don't sign a loan document, sure, but economically it's identical.
How so?
You have given them cash today. In exchange, they have a liability to pay you back conditional on some event in the future. They hold the cash, they owe the liability. That is, for all intents and purposes, a loan.
Okay, I see that.
But the terms of this loan are what make the insurance business model the absolute envy of the financial world. The cost of this loan, it isn't set by the Federal Reserve.
No.
It's determined entirely by the underwriting performance.
Walk me through that. What do you mean by that?
Okay, so if the insurer operates at an underwriting profit, meaning their combined ratio is less than 100%, so the premiums they collect exceed their claims and their expenses, they are effectively getting paid to borrow this money from you.
Whoa, okay, let's pause on that because that is such a wild concept compared to normal banking.
It is.
If I go to a bank to get a loan to invest in the stock market, the bank charges me 7-8% interest?
Something like that, yeah.
I start 7% in the hole. I have to beat that 7% just to break even on my investment.
Correct. You have a cost of capital. It's a hurdle you have to clear.
But you're saying if an insurance company writes good policies they are getting a loan with a negative interest rate.
That is the kick. That is the magic of the whole thing. If they make an underwriting profit, their cost of funds is negative. They have been given capital plus a little extra profit on top, which they can then go and invest.
That is better than free money.
It is money that pays you to take it. It's an insane concept.
So what's the flip side? What if they're bad at underwriting?
Of course, that happens. If they operate at an underwriting loss, which happens a lot, especially in soft markets or big catastrophe years, then that underwriting loss becomes the cost of float.
So if they lose 3% on underwriting,
their cost of funds is 3%.
which is still likely cheaper than going to the bond market and raising corporate debt.
Oh, absolutely. So even a mediocre insurance company often borrows money cheaper than a bank can. As long as their investment returns on that giant pile of cash exceed their cost of the float, the company is profitable.
This brings us to the equation that drives the whole sector, right? The return on equity, or ROE.
Yes.
I feel like people look at an insurance P&L statement and they just get lost in the weeds. But it's really just two engines, isn't it?
Two completely distinct engines. Engine number one is your underwriting income. Simple enough. Premiums minus claims minus expenses. That's the business of selling insurance.
Okay. And engine number two.
Engine number two is investment income. That is the return generated on both the float and the actual shareholders' equity.
And there's a multiplier effect here, isn't there? I mean, it's not one-to-one.
Oh, it is absolutely a leveraged game. This is what so many people miss. Insurers are leveraged entities.
Explain that.
For every $1 of actual equity capital they hold, money that belongs to the shareholders, they might hold anywhere from $2 to $10 of invested assets.
Depending on the business line, I assume.
Exactly, depending on the business line.
Give me the math on that. Why does that leverage matter so much for the final return?
Okay, so let's use a simple example. Let's say you have $1 of equity and $9 of float. That gives you $10 of total invested assets to play with.
Right.
Now, if you can squeeze out just a 1% higher yield on your investment portfolio, say, you move from earning 4% returns to 5% returns, you aren't just making 1% more.
No, you're making 1% on all $10.
You are making 1% on $10 of assets. That is 10 cents.
Which, relative to your original $1 of equity,
Is a 10% increase in your return on equity. A tiny 1% improvement in investment skill translates directly to a 10% boom in shareholder returns.
that is the power of leverage.
And that is why the investment portfolio is the engine room.
Which explains then why valuation multiples in this sector, price to book specifically, are so strictly correlated to expected ROE.
Yes. The market pays for risk-adjusted ROE. It's that simple. Value creation in insurance basically equals the growth in book value per share plus any dividends you pay out.
So the whole game is maximizing that ROE.
Maximizing it without blowing yourself up. The goal isn't just chasing the highest yield, because that brings risk. If you lose 10% on that $10 portfolio in our example,
You've wiped out your entire dollar of equity. Game over.
game over. So the game is maximizing that ROE while keeping the loan, the float stable and cheap.
Okay, so we've established that these companies are sitting on these enormous piles of cash that they need to invest. But they can't just go and dump it all into Bitcoin or volatile tech stock.
Heavens no, they're highly regulated.
They're constrained. And this brings us to what you call the golden rule of insurance investing, asset-liability management, or ALM.
ALM is the Bible of the industry. It governs everything. And the rule is actually quite simple.
What is it?
You cannot invest money you might need tomorrow in an asset you can't sell for 10 years.
Simple, but powerful.
The nature of the tail, meaning the liability profile, how long you expect to hold the money, that dictates the asset. You have to match the duration of your assets to the duration of your liabilities.
Let's break this down by sector, because a property and casualty company looks totally different from a life insurance company, right?
Raisin day.
Okay, so let's start with P&C, property and casualty. This is your auto insurance, your homeowner's insurance, from someone like Allstate or Progressive. What does their tail look like?
P&C is considered the short tail.
Short tail.
Think about the nature of the liability. Auto accidents, hurricanes, fires. These things happen suddenly. They're stochastic. They're random events.
And when they happen, the policyholder expects to get paid. Now,
Immediately. You can't tell a homeowner whose roof just blew off, hey, sorry, just wait 5 years until our long-term bond matures and we'll get you that check.
they need the check next week to pay the contractor. It's an urgent need.
Exactly. So the liability is short-term, and crucially, it can be very volatile. A bad hurricane season in Florida can trigger massive, unexpected outflows of cash all at once.
So that must affect their whole strategy.
Completely. Because of this, P&C companies typically hold less leverage, maybe 1x to 2.5x their premiums in float, and their investment strategy demands much higher liquidity.
So what does their portfolio actually look like? What are they buying?
It's a cash flow approach. They need shorter duration bonds, highly liquid securities, things they can sell tomorrow without taking a huge haircut.
So less risky stuff.
Generally, yes. But interestingly, they often have a slightly higher tolerance for equities, for stocks, than life companies do.
Wait, that sounds completely counterintuitive. Why would the company with the more volatile, unpredictable liabilities hold the more volatile assets like stocks?
It's a great question. It's because they don't have 30-year guaranteed liabilities they have to match dollar for dollar. A P&C liability is an estimate. Once the claim for the car crash is paid, it's done. The contract is over.
So they don't have a contract that says, we will pay you exactly 4% a year for the next 40 years.
Exactly. They don't have that long-term fixed promise. So they can afford to have some market volatility in a portion of their assets, maybe a 15% or 20% allocation to stocks, as long as they have enough cash and short-term bonds on hand to pay the day-to-day claims.
So for a Geico or a Progressive, the profit driver is really that underwriting discipline, getting the premiums right.
It's a real balance. I'd say roughly 30% of a P&C firm's profit comes from underwriting, and the other 70% comes from the investment income. That's a rough industry split, but it shows you that underwriting matters a lot here. If you write bad policies in P&C, you will go broke very, very fast.
Okay, now let's pivot to the complete other side of the spectrum, life insurance. This is the long tail.
The very long tail. We're talking about death benefits and annuities. The payouts are often decades away.
So if you sell a 30-year-old a life insurance policy,
You probably won't pay out for 50 years. If you sell a retiree an annuity, you are promising a steady stream of payments that might start in 20 years and last for another 20.
so it's less about random hurricanes and more about very predictable actuarial tables.
It's all math. It's highly predictable across large populations. We know with a pretty high degree of certainty roughly how many 50-year-olds will pass away next year.
And because of that predictability.
The leverage profile is massive. Absolutely massive. Life insurers often hold 4x to 10x their premiums in float. Because they hold the money for so long, that pile just gets huge over time.
So how on earth do they invest that mountain of cash?
Their entire strategy is something called duration matching.
Duration matching.
They need assets that pay out steadily for 20 or 30 years to perfectly match that liability schedule. If I know I have a contractual obligation to pay you $1,000 a month in the year 2045,
You need to buy an asset today that generates cash for you in 2045.
precisely. I need to buy a bond today that matures or pays a big coupon right around 2045.
So they are the big buyers of long duration bonds.
They are the bedrock of the long-term bond market. They focus heavily on long-duration fixed income, commercial mortgages, and increasingly illiquid assets.
Why illiquid?
Because they don't need to sell the asset tomorrow. So they can afford to buy things that are hard to sell, private loans, complex securities, provided they pay a steady, predictable yield for decades.
And the profit driver here is different too, right? It's not the same 30-70 split.
Completely different. It's almost the inverse. In life insurance, underwriting profit is almost negligible. Sometimes it's even negative.
Wait, what?
I'd say about 90% of the profit for a life insurer comes from investment spreads. Only maybe 10% comes from underwriting.
So they essentially sell the insurance at cost, or even at a slight loss.
Basically, yes. Life insurance is fundamentally a spread business. It's an asset gathering business. They take your money, they promise to credit you 2% or 3% inside the policy, and then they turn around and try to invest that money at 4% or 5%.
And the difference, that spread, is their entire profit.
That's the whole game.
So when I look at a life insurer's ticker, a MetLife or a Prudential, I shouldn't really be thinking about mortality rates. I should be thinking about them as a spread banking operation.
That is a much better mental model. They are effectively banks that gather their deposits through selling death benefits and retirement products instead of opening savings accounts.
Okay, now there's a third category here that often gets lumped in but is actually a total anomaly. Health insurance.
Right.
United Health, CVS, Aetna, Cigna, the giants.
Health is the high velocity anomaly.
Why do you call it high velocity?
Just think about the transaction itself. You go to the doctor, you get the service, the claim is filed, it is paid almost immediately.
The cycle is weeks or months, not years or decades.
Exactly. So the flute is tiny, They only hold maybe 0.1x to 0.3x their premiums. The money is in and out so fast.
So they barely hold the money long enough to generate any meaningful investment income.
Correct. Which means for health insurers, the profit model is the inverse of life insurance. It flips back. Maybe 80% of their profit is from underwriting. Only 20% comes from investment income.
So if a health insurer messes up their medical loss ratio, if they pay out too much in care relative to the premiums they brought in, investment income cannot save them.
No chance. They just don't have the leverage from the float to make up for underwriting mistakes.
And looking at the research for this deep dive, there's this fascinating hidden float in health insurance that I really want to unpack.
Yes.
Because I think this is where the smart money sees value that the average retail investor just completely misses. It's not just about the premiums they hold, it's about accounts receivable.
This is a nuance that really separates the pros from the amateurs in analyzing this sector. It's so important. Health insurers create a different kind of float by, well, delaying payments to providers.
To the doctors and the hospital systems, delaying payments.
Yes.
That sounds strategic.
Oh, it is a feature, not a bug, of the system.
Yeah.
Let's look at it from the hospital side for a second. If you look at the average U.S. hospital, their accounts receivable, that's money they are owed for surgeries already performed, babies already delivered, sits at around 47 days.
47 days. So a hospital does a heart bypass on January 1st. They incur the cost of the surgeon, the nurses, the electricity, all the equipment.
All of it.
And they don't see the cash from the insurer until mid-February.
If they're lucky. That is 47 days of revenue that the hospital has earned, but the insurance company is still holding on to that cash.
Let's put some real numbers on that because the scale is just shocking.
Okay, let's take a massive system like HCA Healthcare. Based on recent data, they might have something in the neighborhood of $8.4 billion in accounts receivable.
Billion with a B.
With a B. That is $8.4 billion. That is rightfully HCA's money, but it is currently sitting in the insurer's bank accounts, not theirs.
And that money isn't just sitting under a mattress, is it?
Of course not. The insurers are investing it in short-term securities. Even at a conservative 4% yield, that $8.4 billion generates roughly $336 million a year in interest.
For the insurer.
For the insurer. That is $336 million of pure profit generated simply by taking 47 days to pay a bill.
That is incredible. It's a pure arbitrage on administrative friction. The hospital loses the liquidity and the time value of that money.
And the insurer gains the investment yield. One man's float is another man's accounts receivable.
Wow, and that explains the constant battle.
Exactly. This dynamic is why you see such a battle of wills over revenue cycle management. Hospitals want that AR number down to 30 days. Insurers were perfectly happy keeping it at 50 or 60. Every single extra day they delay payment is free interest on billions and billions of dollars.
It really reframes the whole inefficiency of the U.S. healthcare system narrative. The inefficiency is highly profitable for the guy holding the checkbook.
It's not a bug, it's a business model.
Let's zoom out to the broader historical context of these portfolios. We know the 60-40 portfolio, 60% stocks, 40% bonds, is the classic retail investor advice. But for insurers, the 60-40 is a complete myth, right? It doesn't exist.
No, it's vastly, vastly more conservative. If you look at the aggregate industry data taking, the figures from the NAIC bonds are the absolute bedrock.
What are the numbers?
As of year-end 2022, bonds made up about 62.3% of total industry cash and invested assets.
Over 60% in bonds. That's a huge allocation.
Yeah.
And equities.
Common stock was only about 13.2%, and that number actually declined recently, mostly due to market valuation drops in 22. The rest is a mix of things like mortgages, which are about 8.9% and rising, and other alternative assets.
So this heavy, heavy reliance on bonds means they are incredibly sensitive to interest rate cycles. We all lived through that low-for-long era, where rates were basically nailed to the floor at zero. What did that do to these companies?
It was a brutal environment for insurers, especially the life insurers. Remember, their whole business is the spread.
Right.
If safe government and corporate bonds are paying you 1% or 2%, it is very, very hard to maintain a profitable spread. If you sold a policy back in the 90s where you promised your policyholders a 3% return.
You're upside down. You're bleeding money on every policy.
They're bleeding, exactly. And this forced them to stretch for yield.
What does that mean in practice?
It means they had to move down the credit spectrum buying riskier bonds, maybe BBB instead of A-rated, or they had to move into more illiquid, complex assets to find that extra 50 or 100 basis points of return just to stay afloat.
Then, in 2022, the script completely flipped. Rates skyrocketed. We saw the fastest rate hiking cycle in modern history. That had to have just crushed the value of those old low-yielding bonds.
Oh, it crushed the market value. This is simple bond math. When yields go up, prices go down. If you own a bond paying a 2% coupon and the newly issued bonds are paying 5%, nobody wants your 2% bond. Its price collapses.
So you saw these massive, unrealized losses pop up on insurer balance sheets everywhere.
Billions and billions of dollars in paper losses.
But, and here's where it gets really interesting for me, the insurers didn't seem to panic. We saw Silicon Valley Bank literally collapse because of this exact dynamic. Why didn't MetLife or Prudential collapse?
It comes down to the accounting rules and, more importantly, the business model difference.
Okay.
Silicon Valley Bank had depositors who could ask for all of their money back instantly. It was a classic bank run. Insurers have policy holders who can't, or at least usually don't do that.
You can't just call up and demand their death benefit today.
Exactly. So most insurers classify their bonds as hold to maturity. They don't plan to trade them. They plan to hold them until they mature in 20 or 30 years.
So the drop in market price is just a paper loss. As long as they don't have to sell the bond, they don't have to lock in that loss.
It's the Schrodinger's cat of losses. It's not real until you open the box and are forced to sell the bond into the market.
And there's a silver lining to the higher rates, too.
A huge silver lining, it's the reinvestment rate. Every single month, old bonds mature. Maybe those old bonds were paying a measly 2%. Now, the insurer takes that principal cash and buys a brand new bond paying 5% or 6%.
Which widens their spread and makes them more profitable going forward.
Exactly. So the short-term pain of unrealized losses on the balance sheet is actually setting them up for much improved long-term profitability.
However, we are seeing a big shift in what they're buying with that new money. It's not just swapping an old public corporate bond for a new public corporate bond.
No, not anymore.
We are seeing this huge rise in structured finance and private credit.
This is one of the most significant and I think underappreciated trends in the last decade. Insurers are structurally shifting away from plain vanilla public corporate bonds and into things like ABS asset-backed securities and private credit.
Are the numbers that big?
They are. ABS and other structured securities actually rose to become the second largest bond type in insurer portfolios in 2022, surpassing even municipal bonds.
Wow. So why? What is the allure of these complex instruments? Why buy a bundle of, say, car loans or a private debt deal instead of just buying a generic, easy-to-understand IBM bond?
It all comes down to one phrase: the illiquidity premium.
The illiquidity premium.
Remember, insurers, especially life insurers, do not need daily liquidity. They don't need to be able to sell their assets on a Tuesday afternoon.
A mutual fund might need that. An ETF definitely needs that.
Right, because their investors can click sell on an app at any moment.
Yeah.
But a life insurer knows with high certainty that they won't need the principal from that investment for 20 years.
So they are getting paid extra for a constraint liquidity that they don't actually have. Yeah.
You've nailed it. They can buy a private loan, maybe a loan to a mid-sized software company or a structured portfolio of equipment leases that yields, say, 200 basis points or 2%, more than a public bond of similar credit quality.
And that extra yield isn't necessarily for extra credit risk.
Not entirely. A lot of that extra yield is simply because the asset is hard to sell. It's the illiquidity premium. And since the insurer intends to hold it for 20 years anyway, that is just free yield for them.
This shift into private assets brings us to what I think is the biggest structural transformation in the industry right now. And frankly, this is the part of the deep dive that I think matters most.
I agree.
If you tune out everything else, you need to listen to this. We're talking about the collision of insurance and private equity. The AAM model alternative asset managers.
This is the great convergence. It's the reshaping of Wall Street as we know it. You see the giants, Blackstone, Apollo, Carlyle, KKR. They are aggressively buying or partnering with life insurers.
We've all seen the headlines. Apollo and their insurance arm, Athene. Blackstone's deal with Allstate Life. KKR buying Global Atlantic. Why do these private equity firms, who normally love high-octane, risky deals, want these boring old insurance companies?
2 words: permanent capital.
Explain that. Why is permanent capital the absolute holy grail for a PE firm?
Well, think about the traditional private equity model. You decide to launch a fund. You spend the next 18 months on a roadshow, flying around the world begging pension funds and sovereign wealth funds for money.
Please give us $1 billion.
Right. And you get the money, you have maybe 5 to 7 years to invest it and then exit those investments. And then you have to give the money back to your LPs. Then the whole cycle starts over. You have to go out and raise a new, bigger fund. It's a treadmill.
It sounds exhausting. You're constantly singing for your supper.
Constantly. But insurance float, specifically the long-tail life insurance float, is perpetual. It doesn't get redeemed as long as the policy is in force. It just sits there growing.
So if you own the insurance company,
you control that massive, stable pool of assets. You don't have to fundraise. The insurance sales force does the fundraising for you every single day by selling annuities to retirees in Florida.
that is brilliant. It literally turns the insurance sales agent into a capital raiser for Apollo's private equity funds.
That's the model.
So what is the strategy once they acquire the insurer? How do they juice the returns and make it work for them?
They execute a very specific rotation. They buy the insurer, which typically has this sleepy portfolio full of boring public corporate bonds yielding 3-4%.
Okay.
They take those assets and systematically rotate them into their own in-house private credit origination engines.
Walk me through the mechanics of that. Give me an example.
Okay, let's stick with Apollo and Athene. Apollo is the asset manager. Athene is the insurer they control. Apollo has a massive credit arm. They go out and originate loans to businesses. Maybe they lend $500 million to a company like Hertz, or they finance a fleet of aircraft. These are private deals, not public bonds. And they yield 6%, 7%, 8%.
And who buys that loan that Apollo just created?
Athene buys it. The insurance company buys the loan originated by its parent company.
Wait a minute. That sounds incredibly ripe for conflict of interest.
It is the multi-billion-dollar question.
Apollo originates the loan. They're essentially grading their own homework, and then they sell it to the insurance company that they own, which is full of retirees' money. Isn't that dangerous? What stops them from dumping bad loans into the insurance company just to get the origination fees?
That is precisely what the regulators are terrified of. They call it shadow banking. Now, the PE firms, they argue this is actually safer.
Safer how?
They argue that because they originate the loan directly, they know the credit quality far better than if they just bought a bond blindly from the public market. And crucially, they argue they are the only ones capable of generating the kind of yield needed to actually pay retirees what they were promised in a low-rate world.
It's a standoff between the regulators and the PE firms. But the math is undeniable.
The arbitrage is massive. If the liability cost, the interest you've promised to the policyholder is, say, 3%, and the private asset you're investing in yields 8%, that is a 500 basis point spread, a 5% spread.
On $100 billion of assets.
The math gets staggering very, very quickly. It turns a boring, low-margin insurance company into an absolute cash machine.
But this introduces a whole new kind of risk for an investor trying to analyze these companies. Valuing a GE bond is easy. I can look it up on a Bloomberg terminal in 2 seconds. Valuing a private loan to some mid-market company, that's much, much harder.
It is much harder. And this is where we need to talk about Schedule BA.
Schedule BA, it sounds like a flight number. What is it?
It's the most important line item on an insurer's regulatory filing if you want to understand their risk. Schedule BA is the bucket for other long-term invested assets.
So the miscellaneous stuff.
Think of it as the junk drawer of the balance sheet, but a very expensive, very risky junk drawer. This is where they put the hedge fund stakes, the private equity interests, and all the weird, complex structured notes that don't fit into a clean bond category.
So if I want to know how much exotic risk an insurer is taking, I need to look at the size of their junk drawer.
Exactly. You watch the allocation to Schedule BA, and you watch the NAIC ratings. There is a ton of scrutiny right now. New rules are emerging from regulators about how these private credit funds are treated and rated.
They want to make sure they're not hiding risk.
They want to ensure insurers aren't hiding leverage. They want to make sure that a BBB-rated tranche of a private credit fund is actually as safe as a publicly traded BBB corporate bond.
Because if it isn't, and we hit a real recession.
If we hit a recession and those private loans start to default, the losses could be very opaque and very sudden. Unlike public bonds that drift down in price as bad news comes out, private credit tends to be valued at par right up until the day it suddenly goes to zero.
Let's pivot to the investor context then. If I'm holding shares of one of these insurers or I'm looking to buy, what are the key risks and signals I need to be watching for? We talked about the mark-to-market versus hold-to-maturity dynamic. What is the absolute nightmare scenario?
The nightmare is a liquidity event. It's the run on the bank scenario, or in this case, a run on the insurer.
How does a run on an insurer even happen? I can't just call up and withdraw my life insurance policy.
No, but you can surrender your annuity. Think about it. If rates spike and you're sitting in an old annuity that's paying you 3% and you see a new product being offered that pays 6%, you might be tempted to pay the surrender penalty and switch. Or what if people just panic about the solvency of the firm itself? If those surrenders spike all at once, the insurer needs cash now.
And they don't have cash. They have 30-year bonds and illiquid private loans.
Exactly. They would be forced to sell those depreciated bonds or those illiquid private assets into a bad market. That crystallizes the paper loss into a real solvency-threatening hole in their balance sheet.
So as an investor, I need to watch surrender rates and lapse rates.
If those start to spike, it's a flashing red light, a huge one.
What about credit quality? We talked about them stretching for yield.
You need to watch the BBB-rated bond bucket. While investment grade, which is NAIC 1 and 2, still makes up about 95% of most bond portfolios, a huge chunk of that is BBB, which is the lowest possible rung of investment grade.
One step away from junk.
Exactly. The definition of safe is being tested. If we hit a nasty recession and a wave of those BBBs get downgraded to junk status, the capital requirements, the amount of cash regulators force them to hold against those assets, skyrockets. It traps capital and can create a death spiral.
And we absolutely cannot ignore commercial real estate. We have to talk about the office apocalypse.
CRE is the elephant in the room for the life insurers. They are huge lenders to commercial real estate. They hold about 15% of the entire commercial mortgage market in the U.S.
And they're heavily exposed to the worst parts. Office and retail.
Very exposed. And we all know the office market is, well, challenged is the polite word for it.
It's a disaster in some cities.
It really is. Now, unlike banks, insurers are less leveraged in terms of deposits, but a collapse in CRE values directly hits the book value of these life companies. If they have to write down the value of those mortgages, if they have to finally admit that the office tower in San Francisco is now worth half of what it was 3 years ago.
Book value gets crushed. And the stock price is likely to follow right behind it.
It has to. So if you are looking at an insurer with a massive allocation to office mortgages in major downtown cores, you need to be very, very careful. Look for their loan-to-value ratios. Look at the geography of their exposure.
This brings us to the one question. We always like to leave our listeners with a single sharp tool to cut through all the noise. When evaluating an insurance company, what is the one question they should ask themselves?
The question is this. Is your cost to float lower than the yield on a 10-year treasury?
Is your cost to float lower than the yield on a 10-year treasury?
Okay, break that down for us. Why is that the ultimate filter? Because the 10-year treasury is the risk-free rate. It's what you can get for doing absolutely nothing, for taking zero risk.
Right.
If an insurance company's cost to float, which is their underwriting loss, is higher than the treasury yield, they are actively destroying value. They are paying more to borrow money from policyholders than they could make by just taking that money and buying the safest asset on planet Earth.
They are a deteriorating utility.
A value trap. But if the answer is yes,
if their cost to float is lower than the T-bill yield,
or ideally, if it's negative because they have an underwriting profit, then they are a compounding machine. They're getting paid to borrow money and then reinvest it. That single question tells you instantly if they are a value creator or a value destroyer.
And you can find this in their filings.
Absolutely. You can find it in the 10K, usually in the management discussion of operations. Look for the underwriting margin or the combined ratio and compare it to the bond yields at the time. It's the only math that truly matters.
Powerful stuff. Let's wrap this up with our key takeaways from this deep dive.
Takeaway one for me is, float is leverage, not free money. It's a loan that has to be matched to the duration of the liabilities. Remember, short tail for P&C, long tail for life.
My takeaway is that the great rotation is real and it's happening now. The industry is structurally moving from public fixed income to private credit and illiquid assets to capture that illiquidity premium. This is the AAM model, and it's changing everything.
And my third takeaway, know the profit engine of the company you're looking at. Analyze P&C firms based on their underwriting discipline. That means you look at the combined ratio, but you analyze life firms on their investment spreads and their asset quality. They are two different animals.
And my final thought for you, our listeners, when you look at an insurance ticker, stop seeing a policy writer. Stop seeing the lizard on TV. Start seeing a massive, highly regulated hedge fund with a very specific mandate. These are financial engineering powerhouses. Trade them accordingly.
Couldn't have said it better myself.
Thanks for listening to Talk Tickers. We'll catch you on the next deep dive.